Hi, I'm Aarati Krishnan from Prime Investor. Today we are going to talk about a subject that many people are interested in. Is it time to invest in US equity? So many investing legends like Warren Buffett, etc., tell us that we should buy when there's blood on the street, right? So today the question that many investors ask us at Prime Investor is that is it time to buy US equities? People are closely tracking what is happening in the US economy, macros, etc., and they know that the indices have corrected quite sharply. So if you look at the key US indices today, they have fallen quite a bit. If you look at the S&P 500, from its peak in January or so to current levels of 3790 or so, it's fallen about 22%. NASDAQ, the tech-heavy index, has seen a veritable bloodbath and it is down about 30% from its peak. The Dow Jones Industrial Average is down by a slightly lesser percentage. So if you look at the extent of the fall, certainly all the US indices are well into the bear market, and therefore people are asking whether it is time to bottom fish US equities. Now this call needs to be taken based on certain data points, we think. So the first could be the extent of the correction that we've seen. The second could be the way the macros are heading in the US, interest rates, inflation, GDP, and so on. And thirdly, of course, is the all-important column where valuations stand for the markets at this juncture and whether this seems to be a good level to enter compared to historical valuations. So let's look at a few data points in order to flesh out this thesis. So coming to the extent of the correction, we can compare the current fall to the previous falls in the US market. We know the biggest crashes happened during the dot-com crash and thereafter the global financial and housing crisis in the US, etc. So during the dot-com crash, if we see the US market, the S&P 500 fell about 25% from its peak to trough. During the global financial crisis, the fall was even deeper and the index fell by 49% between October 2007 and March 2009. During the short but brutal COVID bear market, that is, it was so short, it only lasted a month. At that time, the S&P 500 fell 32% in March 2020. Of course, it rebounded very, very quickly. So going by these falls, we would be compelled to conclude that the current fall is not yet done. It is at 22%, whereas the previous falls have been much larger. So by going by this very simplistic yardstick, we can think that there is some way to go for the US correction. But a more important input into deciding whether the correction is on or not is where US macros are heading. We all know that the trigger for the current correction across global markets came from runaway inflation. So inflation was already slightly creeping up when the Russia-Ukraine conflict suddenly burst upon the economies of the world, and therefore, because of the supply shortages, energy shortages, etc., inflation started to go up. So if you look at the US market, inflation was at a somewhat controlled 5% in October 2021. It shot up above 6% in January 2022, and it went as high as 6.8% by June 2022 in terms of personal consumption expenditure inflation, which the US Fed tracks. If you look at retail inflation, which is the CPI, it went as high as 8 to 9% in June. So this is what actually caused the Fed to embark on its tightening spree. So the Fed has clearly said that we will keep tightening interest rates until we can get inflation down to our comfort zone of 2%. Now there's an enormous distance between where inflation is currently, which is CPI inflation at 8%, and Fed's target of 2%. So we can conclude that the interest rate hikes are going to last for a while. It is very difficult to make macro forecasts about any economy. Since we don't track the US economy that closely, we wouldn't venture to make our own macro forecast. But if you go by the forecast made by the US Fed's board members, which is like our RBI forecast, they have said basically that they see US inflation staying at 5.4% throughout 2022, moderating to 2.8% by 23, 2.3% next year, and they think the inflation will get back to the comfort zone of 2% only by 2025. What this suggests is that basically the inflation pressure on stocks in the US that will remain at least this year and the next. A second factor that has been affecting markets is actually the Fed's reaction to this inflation. So the US Fed, because of the runaway inflation, it has said that it has practically said we will do whatever it takes to quell this by increasing our interest rates. So the rate, which is called the Fed funds rate, which is like our repo rate, it has hiked it by 75 basis points on the last 3 occasions. And this rate has gone from nearly zero in January to 3.25% now. Now, if you look at bond markets, they always run ahead of interest rates actions by the central bank. So that's happened in the US also, and US Treasury yields are now close to 4%. Now, the stock markets will not have this bandwidth to rally until interest rates keep raising. So, higher rates, as we know, reduce equity valuations, and they set a higher bar for equity returns. It makes investors less inclined to invest in equities versus debt. So in the September meeting, actually the Fed board members, what did they forecast for interest rates? They think that by the end of 2022, this Fed funds rate will reach 4.4%. And by the end of 2023, it will reach 4.6%. And that will be the peak rate. Beyond that, it will start to decline. So from this, what we can conclude is that both 2022 and 2023 will be a hostile environment for US equities because the rates will keep rising. Coming on to the third factor, which is that of GDP growth. Today, there's a lot of talk about whether there's going to be a recession in the US economy. And if there's going to be a recession, it's going to be hard times for equity investors because it means that corporate sales and corporate profits cannot grow at the earlier pace. So if economic activities actually shrink in, it is hard for corporate profits to keep growing, right? So that is the logic. If you look at this recession fears, actually in the Q1 and Q2 of of 22, this calendar year, the US economy already showed a technical recession. But people expect a slight recovery in Q3 and again a slip back into recession in Q4. So it's going to be an up and down journey for the US economy. So if you look at the Fed forecast on this, the Fed is forecasting that in 2022, the US economy will be barely growing by 0.2%. It will go up to 1.2% in 2023 and slightly improve from 2024 onwards. So what this shows is that the recession problem, which is going to impact sales and earnings, it is very much going to be in place this year and the early part of next year, right? So if you take stock of all these macro factors, what it shows is that inflation may peak out very quickly, maybe this quarter or the next in the US, and then begin to moderate. But interest rates may keep going up until 2023, 2024, because will be required to keep inflation under check. GDP growth will be a problem this year and next year. So all this does not translate into a friendly environment for US equities. What's more, we are talking here of consensus forecasts. So the actual data may actually disappoint or surprise markets in terms of inflation, GDP, etc. So as each quarterly data point comes out in the US, you will find that the stock markets are either overreacting they get into bull rallies, or they fall very sharply because the data is disappointing or worse than expected. So we can expect a lot of two-way moves in the US market over this year and the next. This gives us the impression that there will be many opportunities to actually bottom fish the US market. There is no need to rush in with all your money at this juncture, because you can deploy part of your money, but certainly not all of your US allocation at one go right now, because we do think the next year or two are going to be very choppy times for the US market. Now, we can make any number of macro forecasts, but ultimately for equity investors to decide whether to invest in a market, it is a call that needs to be based on only one thing: valuations. So all of us know the valuation bands at which the Indian Nifty has traded. We'll take a similar look at where the S&P 500 has traded in the US. So today, if you look at the US markets, actually, where does the S&P 500, where do the indices stand? So if you look at the various indices, NASDAQ is trading at about 23 times trailing earnings. So last 12-month earnings, if you take, NASDAQ is trading at about 23 times. DJIA is the cheaper index because it's full of industrial companies which haven't rallied much, and it's at 17.5 times. And S&P 500 is close to 18 times. Now, 18 times is actually not a bad valuation to enter, because a year ago the valuation was as high as 31 times. So it's corrected quite substantially from that peak. 18 times is also the level at which S&P 500's historical PE, like trailing PE, has traded for the last 10 years or so. But the problem is the last 10 years valuation in the US market has been slightly bloated by all this US Fed pumping of liquidity and so on. So it would be better to take a slightly longer term view of valuations. So if you look at valuations actually, on a forward basis, suppose you are in the current year and you're looking at next year's earnings, on a forward basis, a good time to buy US equities has generally been when the S&P 500 trades at 15 times 1 year forward earnings. So 15 times next year's earnings. If you look at the valuations currently, actually based on earnings of S&P 500, this is how, if you look at the forward valuations table, it shows you that currently the EPS of the S&P 500 is around $205 based on last 4 quarters earnings of its companies. And based on this, consensus analyst estimates today peg 2023 earnings at $242. And based on the 2023 estimate, actually the PE is 15 times. So the S&P 500 is actually trading at a forward PE of 15 times. So if you want to be a bit simplistic and say, oh, this is a great time to invest, let us just deploy money in US equities. But you should remember that in the PE ratio, not only PE, but E is also a moving part. So with recession fears, high rates, inflation, etc., we should actually expect the US earnings also to take somewhat of a hit in the next year or two. So currently for 2022, analysts are expecting that US companies, S&P 500 companies will grow their earnings by 10%. On top of that, they think in 2023, they'll grow their earnings by another 7%. Now we discussed the GDP figures, etc. And so this looks slightly optimistic. If you think the economy is going to grow only by 0.2%, expecting earnings to grow by 10% seems a bit of an overestimate. So if you try to derate those estimates, what if you change that E number based on various scenarios and see where the 15 forward PE will lead us to? So that is what this scenario analysis leads us to. So if you look at it, basically, if you get a 5% earnings growth and a 7% in 2023, the 2023 EPS will be 230 rupees, and that leads to S&P 500 level of 3,400 rupees. At the other extreme, suppose earnings dip by 5% in 2022 and grow by 3% next year, then where will that leave the earnings? That will leave us at 201 per share, 201 as the earnings estimate for 2023. And that will lead to a level of 3,000. There is, if we have no growth in 2022 and 5% dip in 2023, you will get an S&P estimate of 291 based on the 15 times forward estimate. So this leads us to the final takeaway that yes, current levels may be good to start your equity allocations in the US market because we are at a reasonable PE compared to 1 year ago. But the next 1 year or so will offer you many opportunities because the markets will keep falling, rising. So there is no need to feel that you need to allocate all your money at one go. Because it's going to be a choppy period for macros, S&P 500 could take some time to bottom. But based on this very ballpark scenario analysis, the bottom could be anywhere between 2,900 and 3,400 levels is the conclusion we reached. There's one disclaimer here. I mean, nobody can catch the market bottom. And basically, it's very hard using just numbers to arrive at where the bottom will happen, because when panic bottoms happen in the market, they can often take valuations far below rational levels or historical levels. So if you remember 2008-9 in India, actually the Nifty P went as low as 8 or 9 times, whereas today we are talking of investing at 18 times, right? So basically, it is important to remember that panic bottom can take you below this, but this is a good enough level to invest. We'd also like to tell investors that today the Indian market looks far better than the US market in terms of fundamentals. Therefore, don't go and allocate excessively to the US markets. If you're having an equity allocation of 100 rupees, we would advise putting 10 or 15 rupees in the US markets. hope this has given you some idea of how to basically look at bottom fishing in the US markets, and you're able to take advantage of it.